Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management, where we attempt to be the voice of reason in a world full of the pundits of pessimism and the wall of worry. As always, please make sure you read the disclosures that were attached to this video, or if you happen to be watching on social media, you can simply go to www.frossandfross.com and read any of the disclosures that you might find there. And so I was reflecting on what happened during the month of August, and it was a bit of a wild ride for financial markets, really living up to its reputation as being a bit of a tricky month. Things kicked off with a bang when Fitch, the rating agency, downgraded U.S. long-term debt. They pointed their fingers at, and I quote, expected fiscal deterioration over the next 3 years, a high and growing general debt burden, and the erosion of governance. And frankly, I think Fitch put it mildly when they said that. Now, some of the folks in the financial world scoffed at this move, calling it ridiculous, but it really sent ripples through the stock and bond markets. However, despite the credit hiccup, markets really seemed to soldier on, grappling with debates about the country's financial health. Thankfully, better than expected earnings reports and a sunny outlook kept the faith in corporate America intact. Now, you could see this durability in a few ways. First, the U.S. unemployment rate was sitting pretty low, matter of fact, at a multi-decade low at 3.5%, which meant folks are still out there with a job and still spending money. Also, back to school shopping was strong, hinting at a hopefully positive upcoming holiday season. Even in the housing market, which is facing much higher mortgage rates, it showed its strength thanks to low housing inventory, which kept those prices going up. But let's not kid ourselves. There was some turbulence. Stock markets had a little bit of a dip, and those 10-year Treasury yields continued to rise. Reports on consumer confidence and job openings were also a bit softer than expected. All of this made folks wonder if the Federal Reserve would hit us with another rate hike this year. The debate over that rages on, but the stock market decided not to wait and continued its upward march as the month wrapped up. Now, we've had an incredible June and July in the stock market, and even with what happened in August, we still only dropped 1.77%. Still keeping the S&P at a double-digit high for the year. So I think that's just perspective. Now the question is, what's the outlook for the rest of the year, especially since September usually brings its own set of challenges? Well, history tells us that when the market starts off strong in the first 7 months of the year, that we then tend to see average returns of about 5% until the end of the year, so another 5% gain. Now, given that the S&P has had really strong performance the first 7 months, even the first 8 months of 2023, it's possible, we at least hopeful, that we're on track for a positive finish, although we expect bumps along the way. As always, if you have any questions, feel free to reach us here at the office, 352-205-7800. And we look forward to seeing all of you very soon. Have a wonderful day.